The S&P 500 is sitting near a record high, and that has investors asking a familiar question. Is the market getting too expensive to buy? I'm Georgia Stewart, and this is the fastest 4 minutes in finance. The S&P 500 recently hit 7,758 points, and it's up by about 13% this year so far. That's a pretty impressive run, but investors aren't exactly feeling comfortable. Inflation is still a concern. Oil prices are moving higher. The latest jobs data showed employers unexpectedly cutting jobs. And as of this recording, investors were watching the recent inflation report for cues about what the Fed does next with interest rates. So you've got a market at record highs with a whole lot of uncertainty underneath the surface. The question is, should you be pulling back? Let's start with the history. According to research from JP Morgan, the S&P 500 has actually performed pretty well after reaching record highs. From 1988 through 2024, the average one-year return after the S&P 500 hit a new high was about 13%. That's compared to about 12% after an investment made on any random day. And over 5 years, the difference was even more interesting. The average cumulative return after buying at a record high was about 81%, compared to about 75% on any random day. Keep in mind that's historical data. Past performance is not indicative of future results. Now, that data isn't a forecast, and it doesn't mean the S&P 500 is going to return 13% over the next year. But it does challenge one very common assumption, that when the market hits a record high, it must be getting close to a ceiling. History doesn't really support that idea. And this is where Warren Buffett's philosophy comes in. Buffett has never made the broader market's latest record high the centerpiece of his investment strategy. The focus has been on what you're buying and what you're paying for it. That's an important distinction because the S&P 500 can be at a record high while individual companies and sectors have very different valuations. But that doesn't mean investors should ignore today's risks. The S&P 500 is currently trading at roughly 28 times earnings, which is above its 5-year average of around 24 times. So yes, the market isn't exactly attractively priced based on that measure. And that's happening at a time when investors are already watching inflation, interest rates, corporate earnings, and geopolitical risks. In other words, there are plenty of reasons to be cautious. But there's a big difference between saying the market looks expensive and saying the market is about to fall. Those are two completely different statements, and nobody knows the exact timing of the second one. That's why understanding your time horizon matters so much. If you're going to need your investment money in the next couple of years, a major market decline could be a serious problem. But if you're investing for retirement 10, 20, or 30 years from now, a short-term pullback is a very different situation. In fact, LPL research points to some pretty striking long-term history. The S&P 500 has produced a positive return over 10-year periods about 94% of the time. And over 20-year periods, the index has historically delivered positive returns. Again, that's past performance, not a guarantee of what happens next. Let's use an example from the dot-com era. Imagine investing $10,000 at the market peak in March of 2000. The timing couldn't have been much worse. The market plunged afterward. But according to LPL research, an investor who stayed invested and reinvested dividends would eventually have seen that hypothetical $10,000 increase to more than $80,000. Now, that is hypothetical and doesn't account for fees or taxes. But that's the part of investing that headlines don't always capture. You don't need to believe the market is undervalued to understand why abandoning a long-term plan because of one headline could be risky. And you don't need to believe the market is going to keep going up either. The market can absolutely fall. It can fall sharply. The challenge is knowing when to get out and then knowing exactly when to get back in. So when you see the headline, S&P 500 hits another record, don't automatically treat that as a buy signal, but don't automatically treat it as a sell signal either. Instead, ask a few better questions. What am I invested in? What am I paying for it? How much volatility can I realistically handle? And most importantly, when am I going to need this money? Because a record high is news, it's not a forecast. And if your long-term investment plan still fits your goals, your time horizon, and your risk tolerance, today's headline alone may not be a reason to abandon it.
Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.